particularly focused on a recent paper that I wrote with Satoshi Ikeda on the principles for capital buffers to address systemic risk. So very quickly, what do we know about climate risk and financial stability? So I made a few bullet points that for me summarize a bit what I take out of the whole research and debate around systemic risk and climate risks. So I think one fact that is not contested is that climate risks are potential systemic risks. So as I said, this has been acknowledged and repeatedly said by several supervisors, including the Financial Stability Board, the IMF, and the NGFS, and others. So we start this with this fact that there are systemic risk. Now, what we also know is that systemic risk from climate change are also very likely to be underestimated. That is also said by the FSB and the NGFS, saying that we have now tools to assess climate systemic risk, but we know that these tools have deficiencies. They do not take into account all potential feedback loop, for example, between within the financial sectors and with the economy. And the estimation that we have now are likely to be a lower bound of the risks that we estimate. So the systemic risks are likely to be higher than what we can estimate with our tools now. Another very important fact is that the level of systemic risk depends a lot on the transition path that the economy will take in the next few years. And basically, I think most of the supervisors came to the conclusion that an orderly transition that starts now or that should have started is a scenario that minimizes risk for financial stability. So having an orderly transition starting now, that's the best thing that we can have for financial stability. If we have other paths like a delayed transition or even no transition at all, then we very likely end up in a world where you have more financial stability. So for a financial stability point of view, having an orderly and timely transition is very important. Another few things that we know is that climate risks are unevenly distributed in the financial system. Some actors and sectors are more exposed to climate risks than others. We also, most of the supervisors acknowledge that banks are not well prepared to manage climate risk. So they make progress, but they have not reached yet a level that a lot of supervisors feels confident with. So basically here, yeah, there is also some loopholes in how climate risks are managed, which is relevant for financial stability. And lastly, financial institutions contribute to climate change and the buildup of climate risk. I mean, basically, where banks invest also decide which transition path we will take. And as I said, the transition path that we will take is relevant for financial stability. So generally, when we talk about addressing climate risk with macroprudential policy, I think everybody concurs that if there is a systemic risk in the system, then we need a macroprudential response. And this macroprudential response is a holistic response. So it should span across all pillars that framework have, that financial supervisors have. It should start with a sound macroprudential policy. That's the basic of any good macroprudential policy, that you have in the beginning a sound macroprudential policy. Climate risk must be dealt at the individual level first, and then the systemic risk, in addition to risk to individual institution, then should be dealt by macroprudential policy. And as I said before, the tools that financial supervisors can currently have can be deployed for climate risk. And in the range of tools that financial supervisors have, macroprudential capital buffer have attracted attention, and it seems that it's a promising option. I put here 3 references for that. The last one is from the ECB that shows how you can design such buffers. So as you see, for some supervisors, the reflection about how to use a macroprudential capital buffer for climate risk is already well advanced. And before I give you the 4 principles that we think a capital buffer should follow, let me just remind you what are the fundamental objectives of macroprudential policy. So macroprudential policy tools have usually 2 goals. I mean, the macroprudential framework in general, each tool can have one objective, but the whole framework should have two objectives. First, it must ensure that the financial system can absorb shocks. So if you have macro shocks, the system should be able to absorb them. That's a resilient objective. But also, the macroprudential framework should be designed to contain the buildup of financial vulnerabilities. So make sure that financial vulnerabilities at the system level do not increase with time. So that's a mitigation objective. A typical example for that are the countercyclical capital buffer that are here to kind of dampen the growth of credit in the system to avoid credit bubbles. So now turning to climate systemic risk. So we looked at how systemic capital buffer can be used to address climate risk, and we did that with the 2 objectives that I just said in mind. So a resilience objective and a mitigation objective. So we kind of came up with 4 main principles that macroprudential capital buffer should follow to have or to fulfill these 2 objectives. First, the first principle is absorption. So capital buffer must be calibrated to absorb the shock. The second is prevention. The capital buffer must also be calibrated to mitigate the buildup of climate risks. That the two objectives that I told you before. And the third principle is individualization, and this is necessary to create some financial incentive for banks to fulfill the prevention objective. I will explain that later. And finally, recalibration. But the buffer that we suggest should not be should be recalibrated depending on how systemic risk evolved in the system. So first, the absorption principle. So that's the basic of a capital buffer. It must absorb the shocks. And for that, we, as any other systemic capital buffer, the buffer must be calibrated on unexpected systemic losses. So basically the losses at the tail of the losses distribution coming from climate shocks. And these shocks can be both physical and transition risk. So it should reflect both to absorb any type of climate shocks. And the consequence for that is that the buffer should also reflect the structure of the economy. So physical and transition shocks can be very different from one economy to the other. And therefore, there is no one-size-fits-all buffer for each economy, but it should adapt. It should reflect the structure of the economy. So here is just a figure to illustrate that. So the buffer should reflect both physical and transition. And then, in some countries, you have much more transition risks than in others. In a lot of countries, it's mostly physical shocks. So this should be reflected in the size of the buffer. Now, the main principle for me is very important in these 4 principles is the principle of prevention. So one of the objectives, as I told you, is of capital frameworks is to mitigate the buildup of climate risks, of systemic risk in general and climate risk in particular. In the context of climate risk, as I told you, the best way to minimize systemic risk and to increase financial stability in the future is to have a transition, an early transition. So if you want to mitigate the buildup of climate risk, then you should work for the transition. So financial supervisors have an interest in seeing the transition happening because that's what's going to make financial stability the highest compared to other scenarios. So there is intrinsic interest for financial supervisors to see this transition happening. And with capital buffer, you can support this transition by including incentives that mitigate this buildup. And basically, this incentive is for the financial system to work on mitigation and adaptation measure. So everything that will support the transition and therefore make the risk in the future less. And this should be based on the forward-looking indicators to basically, these indicators should basically reflect how the financial sector is working for this transition. So this is again a figure, like you have an absorption component, and we can think that if the system is contributing to reduce the risk in the future, so if the system is working for the transition and thus reducing the risk in the future, you could reduce the buffer to give an incentive. Or on the other side, if the system is not working for the future, then for the transition, then you could increase that. So I think varying the size of the buffer gives this incentive for mitigating the buildup of climate risk. Now, one thing, if you want to create an incentive, then you also need to have specific institution-specific capital buffer. If everybody has the same capital buffer, then there is no incentive for individual financial institution to work on for the transition. So basically, one bank, for example, that are lending to support the transition could get a lower capital requirement or lower macroprudential buffer because it is working for the stability of the system in the future. And in the contrary, if someone is not investing in the transition or working for the transition, then this institution is basically working to make risk in the future higher. So that should be reflected in its capital buffer. So that's why it's important to have an individualization. It's not a micro-prudential decision. This individualization is made with a macro-prudential view. So you have different buffer for different firms, but that is just for the macro buffer to work at the macro level, and it's not really a micro measure in that sense. So again, here to illustrate that, you have the main component for the sector, and then you differentiate between each institution. Those working for the transition can have a reduced buffer, the other one can have an increased buffer, so that the system, the capital in the system remains the same, but at the same time, you have an incentive for each firm to work for the transition and thus to reduce the systemic risk in the future. The final principle that we have is recalibration. So basically, the systemic risk from climate change will evolve with time, and this will depend a lot on the transition path that the economies will take. If we see a transition happening, then physical risk in the future will decrease, and basically climate risk in general will decrease. And therefore, you can also decrease capital buffer, and because the economy faces less risk. In contrary, if we don't see a transition happening, then we end up in scenarios where you have a lot of physical risk and a lot more risk for financial stability. So basically, the absorption component of the buffer needs to be adjusted to absorb these higher shocks. So you see, I think you should also adapt the level and the calibration of the buffer depending on which transition path we follow in the future. It's also important to adjust the institution-specific component to reflect the institution practices. So if one bank really improve its practices and start changing its business model to adjust to be aligned with the transition, then its institution-specific component should also be adjusted relatively quickly, so that banks have an incentive to change their business model. Yeah, that's just an illustration. If we start now at a given level, and then we see a transition happening in 3 years, then the absorption component can decrease, and if we don't see any transition, then we should increase the absorption component. Last, so that are principle that we think should underpin the calibration of capital buffer. That, with that in mind, we should also be aware that macroprudential instruments have an intended side effect. Of course, if you increase capital requirement, capital buffers in the system, that could also reduce the aggregate volume of loan in the system, a kind of a credit crunch, and this should be taken into account. It's important also that the capital buffer do not penalize firms that are currently with an unsustainable business model, but who are engaged in the transition and need funding for this transition. There is also the risk that if some jurisdiction implement such buffer alone, that would have push firms to go in other jurisdiction. And again, if you
WebEx Assistant is enabled to save audio highlights.
and basically also when such buffer are introduced, you should also carefully introduce them so that it does not create transition risk in itself. So basically, addressing climate risk requires kind of a nuanced, forward-looking response based on the principle that we highlighted here. And I will stop here.
Okay, thank you very much, Pierre. I already had a few questions around that. It's a very interesting presentation and it raises quite a few topics. But let me first hand over to Laura to maybe share her initial thoughts, and then we can take it from there.
Sure, I'll do that. And first of all, I mean, congratulations, Pierre. It's a really important paper. So yeah, thanks a lot for the opportunity to reflect a little bit on this important paper. It makes a really valuable contribution to this evolving discussion on how macroprudential policies can address systemic risks. Just a couple of words maybe about UNEP FI and what we're doing in this phase. So as I said, we're a partnership between the UN Environment Programme and the financial industry. We host a number of voluntary initiatives like the Principles for Sustainable Insurance and the Principles for Responsible Banking. We're really happy that through the PRB, we have about half of the global banking industry committed to sustainability goals. But of course, we realize that voluntary action through these frameworks only gets us that far. And so we also do a lot of work with central banks and supervisors to strengthen the enabling policy environment and make the voluntary and the mandatory speak to each other a little bit better, as so to speak. So we provide services to our bank and insurance members, for example, around regulatory implementation support. But we also provide some technical assistance to central banks and supervisors themselves. And in APAC, that's a lot of that is around taxonomy development. But coming to the substance, I'd like to give my personal 5 cents on the main findings of the report, and I have 5 main takeaways. I don't have slides, so bear with me. The first one is a little bit obvious, but also not that obvious, which is that I just want to congratulate you, Pierre, to just adding to this literature and yet another contribution just to demonstrate and add to this growing literature, recognizing that climate change does pose systemic risks. So as you point out, we often talk about the financial stability implications of climate change, but how to actually address the systemic risks, I think, is really important. So we commend the paper for recognizing that both physical and transition-related risks pose potential threats to financial stability, and making the case for treating climate change as a systemic risk is, of course, becoming even stronger and stronger with the increasing evidence of the financial losses from extreme weather events and policy change. So that's the first one. The second one, I think, is just really helpful and important, that the paper sets out really actionable and structured options for central banks in starting to think about these kinds of macro prudential tools. So with much of the attention really having focused on microprudential tools, we're following with very keen interest that more research like this is now being directed at macroeconomic tools and their relevance for climate and also for broader environmental risks. So the really clear and structured design options around the 4 key principles of absorption, prevention, individualization, recalibration are really important. I think with the 4 principles, you do touch on all the relevant dimensions that central banks and supervisors should look at. But as we know, the devil is always in the details, and you got to that in your last slide as well. So on that, my third point is around advancing a precautionary approach. So of course, I think we're all on the same page, acknowledging really the urgency of addressing climate risks through the micro and macroprudential toolbox. And at the same time, it's really critical, as you say, that measures like systemic risk buffers, capital requirements remain, that they're proportionate, that they're predictable, and that they stay risk-based. So financial institutions and the members that we work with, they require really clear and consistent regulatory signals to align capital allocation and risk management. And sudden or fragmented regulatory interventions could have unintended consequences, and you touched on many of those already. And of course, and that could hit the sectors that are most in need of transition finance, as you rightly pointed out yourself. So I think we welcome the really nuanced and yet really practical approach of the paper. The fourth takeaway for me is that the paper does really recognize the issues of data and risk quantification challenges. So we really support your emphasis on the need to improve risk quantification methodologies. As you say, climate risks are complex, they're nonlinear, they often materialize over long time horizons. We're very likely to underestimate them, and all of this makes traditional financial modeling really challenging to apply here. And at the same time, successful capital buffers will depend on very accurate risk quantification to calibrate them. I think especially the mitigation objective is on the tricky side to reflect in buffers. For resilience, so setting a buffer that gets released when the risk event happens, so not actually too different from from how insurance works, might be more pragmatic and more workable in the short term. If I'm not mistaken, the Netherlands is already experimenting with this, having set a small capital buffer for flood events, so allowing banks to be better prepared for credit losses in the event of flooding, which of course in the Netherlands is considered a systemic risk. So yeah, data challenges are going to be even more pronounced if we want to expand this conversation to nature risks. We recently published a paper looking at how central banks are currently integrating nature into their toolbox, and of course found that data and risk quantification is a particular challenge in that area. And at the same time, I think from a resilience perspective, nature also does lend itself to this conversation and how buffers might apply there. And I think all of that to say that regulators need to work collaboratively with financial institutions, with each other, but also with the industry to refine these methodologies and to better capture the financial impacts of climate change. And that brings me to the last point as well, on global coordination. So I think one of the key challenges in macroprudential policy for climate risks is actually the risk of regulatory fragmentation. Different jurisdictions adopting different approaches, leading to potential inconsistencies in buffers or in capital requirements, and the potential for regulatory arbitrage resulting from that. So I think we'd be really keen to see a greater emphasis on the importance of aligning macroprudential frameworks internationally through the NGFS, through the Financial Stability Board, and other standard setters. I think the chance of just one central bank imposing climate buffers as a first mover is pretty low in the uncertain times that we're in now. And I'd be really keen to actually get your take on that as well. The balance between, physical and transition risks in the current geopolitical environment. But especially, I think, given countries are really keen to protect the competitive outlook of their financial sectors, we need this collaboration if capital buffers or other macroprudential tools are going to get off the ground. I'll stop there. I hope those points were helpful for some perspective and to kickstart the discussion.
Yeah, thank you very much, Laura. Let me quickly give Pierre a chance first to respond to anything or make any comments. And then in the meantime, for the audience, please also, if you have questions, feel free to put them in the chat box, or you can join us later and say them yourselves. Thank you. Pierre?
Yeah, thanks a lot for the comment, and also for having found that the paper is useful. So I share most of the things that you say. I think I wanted to highlight one aspect about data and what kind of data we need. I think clearly more data about exposure to risk is important. So, and as you say, risk-based measure, how is the system exposed to climate risk? That is definitely needed to at least calibrate the absorption part of the buffer. So the system, the capital that is in the system should be able to absorb the macro shocks from climate change. Now, for the mitigation part, I think what is also important is to have a sense of the impact of the financial system on nature or on climate. The reasoning behind a lot of part of this paper is also that for financial stability, it's important to see a transition. If you compare all scenarios, of an orderly transition, a late transition, or no transition at all. I think that supervisors kind of unanimously say that the worst case is if there is no transition. And the best case is when there is a transition. Of course, during the transition, you will have transition shock happening, so there are risks also in the transition. But at the end of the journey, financial stability is very likely to be much higher in a world that has transition than in a world, a 5 degrees world. So in that sense, for financial stability, there is an interest in seeing the transition. And to know if we are going on this transition, you also need to have some data about how firms are investing in changing their business model, financial firms, and what are their impacts on climate change in general. So I think that's also something that is a bit missing in the data framework internationally so far. We focused a lot on assessing the exposure to climate risk, and there is not so much about how much the financial system works for the transition or how much it impacts climate in general. So that's for me one point that could be that is important for the future as well. On the international coordination, of course, this is needed, as you say. I'm not sure that small countries can have an interest in introducing that alone. Now, the question is, what is the critical mass for country to start implementing that? I think, as you perfectly highlight, in the current condition, it's very unlikely to see something globally adopted. But in regions, like large region, that you could have a critical, critical mass to start having buffers in like big region. I'm just thinking about Europe, for example, where you already have in Europe what is called a systemic risk buffer. So countries in Europe can, if they want, if they see some systemic risk, implement a systemic risk buffer, which is different from the countercyclical buffer or the capital conservation buffer. So that's a tool that is specific to Europe. That, for example, is not in the US, as far as I know, or in other big economies. So, but it's still used by some European countries. So, in that sense, if you like in a large enough financial system, you can already. I mean, there are examples of measures that are being taken in regions, and where your regulation on capital differs from the rest of the world in a sense. So in that sense, I think if in the Southeast Asian region, if there are some collaboration within the region, I think that's sufficient. You don't need necessarily a global answer. Yeah, that's two of the main remarks from your very nice comment. Thank you.
Okay, thank you, Pierre. Now, I think we do have some questions. There's one in the chat box, but I think Angeza was trying to ask as well. Let me see. I think you should be unmuted, Angeza, if you want to try.
I think so. Can you hear me now?
Yes, yes. Please go ahead.
Okay, amazing. Good morning, Pierre. Good morning, Aziz. Good morning, Laura. Good morning, everyone. Thank you for organizing this session. Very nice to discuss about capital buffers connected to climate change. I had two practical questions. First is about the current disengagement, especially of the US. So how is it likely to be deployed in the future? Will it be a short-term impact, or rather a new trend, although we cannot ignore climate risks? And then the second one, I would be very happy to know more about what international supervisors have been doing so far. For instance, I've seen a few papers from the BIS, but are there any frameworks from the BIS, for instance, on this capital buffers on climate change? Thank you.
Maybe I thought if you have comments, you also welcome. But I think regarding the US, so climate risk is climate it's physical. So whatever you, even if you ignore it, then it's there. That's preliminary. Now, I see one big challenge with the US retreating like that is one challenge is also about data gathering. I mean, if we stop collecting data in the US on climate risk, if we stop collecting data about what do financial institutions do in terms of climate change or in terms of preparing for climate risk management, I think you highlighted that we need good risk data to address climate change in general. I hope that this whatever the regulatory change are or the policy change are, I hope that it will not also come with worse data than what we had before. We already had not good data, so now I hope it will not be worse. In terms of reflection at the BIS level, so there was, as far as I know, some work done on macroprudential policy. I think the FSB is due to publish this year. I hope it didn't have already kind of a review of best practice in terms of macroprudential policies. That still need to be confirmed. Now, linking that to the situation in the US, I don't think that there is a lot of appetite now from the FSB to come with more, more, let's say, policy decision. I mean, I think having at least a review of best practices is already something good at the FSB level. In Europe, it's a bit different. So Europe, they really recognize that it's a systemic risk. They've taken a lot of microprudential decision in terms of also of assessing how financial institutions are managing climate risk internally. Do they do it well? They assess that. They think they don't do enough, so now they've taken measures to improve that. There is also much more. I mean, the ECB has published over the last 4 years several yearly documents, each time advancing the research on systemic risk. The last one that they produce is also highlighting all the potential macroprudential options that we have, so capital buffers, but also concentration risk. You also have borrower-based measures that can be used, so it's not only capital buffer. And the EBA has also recognized that and is apparently working on collecting data or making the systemic risk buffer, European systemic risk buffer framework also compatible with climate risk. So I think there is much more advancement in terms of policy process. Now again, whether it will continue, that's a big unknown for me.
Thanks, Pierre. And I think I was just going to add one more point on that. Obviously, the key issue regarding the US and so on. And I think potentially, since we're based here in Asia, I think it's a good opportunity for Asia and Asian countries to take more of a lead on climate risk, particularly since obviously it is affecting countries here directly. And one of the challenges has always been, people didn't like being driven so much by Europe, for example, saying, given that they've already industrialized and have kind of already done their share of the pollution, whereas this region still needs, further growth and so on. So there might be an opportunity here to help to change some of the model and apply, for example, these kind of systemic risk buffers in a way that can be incorporating both climate risk concerns and helping to promote newer renewable industries and so on to allow job growth and that side of things. So, potentially there is an opportunity to do some more thinking around that. Okay, Laura, anything else to add, or should we just should I read out the next question from Jochen?
I'm happy to do a quick reaction as well, and then jump over to Jochen's question as well. I think, I mean, the only thing to add to the question of how sustained and how long term the US withdrawal is going to be is that I think the withdrawal from the Paris Agreement and the retreat of this agenda is in and of itself not entirely surprising, right? I think having watched Trump's first term and leading up to the election, I think it was pretty clear that this wouldn't be high on his list of priorities. What has, I think, surprised observers is just the speed at which he's dismantling some key pillars of this work. But I think, as you say, Pierre, the extreme weather events are not going to go away. So I think the most durable change is that for the next few years, the focus is going to continue to shift from transition back to physical risks. Very much where this all started. So I think that's probably the change, and again, as you said, aligns really well as well with the agenda here in Asia Pacific, right, where we see much heightened focus on adaptation to begin with. Shall I jump into Jochen's question already?
Yes, please go on. Yep.
Keen to hear your views. Sorry, go ahead.
Yeah, maybe you can just read it out a little bit as well, and then go ahead.
Yes, so Jochen is asking about the current discussion around corporate disclosures and whether supervisors actually find the information that they need in order to implement risk-based capital buffers. So based on corporate disclosures and corporate transition plans. And I think also you're getting at what that means under the current EU political environment and the ongoing omnibus and rolling back some of that as well. I think my short answer would be no. I don't think central banks and supervisors have all the information they need to design policy tools like this for the moment, but it shouldn't prevent us from thinking about how to do it anyways. I think it's also good just to remind ourselves that corporate disclosures and prudential disclosures serve very different purposes. We need forward-looking risk-based information, and we can get that partly from corporate disclosures, exposure to high-emitting sectors, etc. But those serve rather different purposes and need to be adapted. But that's my short take.
Yeah, thank you. And Pierre?
Yeah. So here I differ a bit from you. I think supervisors do have enough data to calibrate such buffer. So I think what you have, the good thing with systemic risk or macro-based measure is that you not necessarily need very detailed and granular to the firm the data. Most of the macroprudential buffers that we have now, like the counter-cyclical buffer, they are based on aggregate measure of credit in the economy, and that's it. And I think what I've seen is that many financial supervisors, they already have done stress tests of their financial system at not like a top-down stress test where you don't need to start with data from firms, but you just look at the macro impact on the economy. And these are typically tools that you can use to calibrate buffers, like macroprudential buffers. So you need relatively macro data for that, and I think they have that. One thing that make me say that is that the ECB, for example, published a working paper where they do calibrate such a buffer. Like the idea, they tried to do it just to see if it was possible, and they do, and they can also, they go up to a point where they also can kind of make it more granular for different type of firms. I think there are 5 categories of firms with different level of risk exposure. So even at kind of the firm level, there is already data. Now, I also say that not in a sense that maybe we don't have now the perfect data for that, but we have enough data. And I think what a lot of supervisors have also highlighted is that, facing the cost of inaction, sometimes it's better to work on data where you have less certainty that you used to be with, like, credit data, for example, but to start with something. Even if you, after 1 or 2 years, when data becomes more available, recalibrate it and adapt it. And so this starting with data that you have is, I think, crucial for me. And I think there is enough data to start something. And yeah, you have to be aware of the potential negative side effect, of course. And you can maybe start with things that you are the more sure about, like the big risks, the big transition risk, for example. We know it's in coal, for example. So there are, I think, enough data to know where are the biggest risks, and maybe start with that, and then expand as data become more granular. But I think there is a fallacy in always postponing to have better data, because we're facing, given the cost that can happen without action now, maybe it's we have to be a bit courageous in the beginning now.
Thank you, Pierre. I think you raise a very good point there about the action, because I think in this region in particular, I think a lot of the regulators and central banks have put in place quite a lot of stress testing requirements, or actually running climate risk stress tests themselves and so on. But we've got to the point where it's not actually hitting the behavior of firms, because there's no sort of penalties and so on. So I think we now need to move to the next step to say, well, if you're the weakest performing in this thing, or whatever, the bank with the most exposures, then something needs to be done to incentivize that change. Okay, let me check if there's any other further questions. Again, you can raise your hand if you want to ask it, or please raise it in the chat box.
If not, maybe just one compliment on your question about transition plan. So I think what is important is to have forward-looking measure. So basically, you don't need to penalize firms that have a legacy business model that is not sustainable. If such firms need to transition, they also need funding for that, and in that sense, they should not be constrained by such measure if they are actually transitioning and need fund for that. So that's where, for me, transition plans play a role, because that's ideally a forward-looking indicators. When a firm says we will invest that much and we will change our business plans over the next 3 years and we need so much funding, I mean, for me, that's a firm that is not exposed to transition risk, in a sense, because they are transitioning. The firms that are exposed to transition risk are the firms that remain in the status quo, are not transitioning. So, I mean, transition plans have their weaknesses concretely. That, as you say, the devil is in the detail. But potentially, I think it's a good indicator for supervisors. And I mean, I don't mean that you need to transition from a supervisory perspective, but the supervisor should at least know where you're heading to as a firm. Are you planning to transition or not? It's a policy decision to say everybody should transition, but for supervisors, it's important to know who is and who is not, because that shows who is exposed to transition risk and not. And again, those who are exposed to transition risk are the firms that are not transitioning, because if a transition happens, then they will face losses. So the firms that are preparing for transition risk and have transition plans for that's an indicator of lower transition risk.
Yeah, there's just a quick follow-up. You can. Do you think metrics compiled by banks based on the primary data generated by real economy firms related EU taxonomy aligned capital exposure is fit for purpose? I'm not sure if you've had a lot of involvement.
Yeah, I don't know if Laura can answer that, but I'm not. That's too technical for me, to be honest. I don't know exactly what EU taxonomy aligned capital exposure. What does this measure really entails? I'm sorry.
Yeah.
I mean, I think, yeah, I think what it does help with is as you say, getting a sense for exposure to high emitting sectors that are most in need of transition. I think that is the kind of information that through EU taxonomy aligned reporting, banks should have a good sense for where their clients stand on that. Of course, that in and of itself, again, is not a forward-looking reporting, right? We do need transition plans for that, or that is the best proxy, so to say. But yeah, I think we're in agreement that while data is imperfect, it doesn't mean that we cannot start exploring these tools.
Okay, thank you. Jochen, maybe you want to, it sounds like you have some views on this, so if you want to join us and share your thoughts, then please feel free. I'm not sure if the system is working though, so in case not, I'm sure we can always take this offline and discuss it elsewhere. Pierre, I just had one quick question just on the capital buffers, right? Because one of the principles was kind of individualization, right, to differentiate the firms, which absolutely makes sense. But then you could argue, well, surely that will also come through if you're doing a sort of ICAP process or that thing, and then the regulators can add on a capital add-on or something which effectively achieves the same thing. So then, why should we go for the capital buffers? And my thinking was more this just raises the point of climate risk to say it's important, and we're creating a new buffer for it, and some firms will be penalized for it to make it more transparent rather than doing it through the more silent approach. Is that correct, or do you think there's other reasons as well?
So I think here, I mean, there is a thin line between micro and macro prudential regulation, basically. I think at the micro prudential level, what is needed is definitely that capital requirement reflects risk exposure. So as any risk, banks should put capital in front of this risk, and that should be reflected at the micro prudential level. That is necessary, and that is also the basis for a good macro prudential policy. Don't need necessarily macroprudential buffer if you have sufficient microprudential buffers. Now, what you're talking about is more, okay, let's say each financial institution has capital for absorption, then the regulators can come up with additional requirements. And I think that is a bit the same as what is proposed in a macroprudential capital buffer. I think where the two are linked is the reason why you do that. So basically, with a macroprudential buffer, you do that for a macroprudential reason. So you have individual buffers, but these individual buffers are there to trigger incentives for macroprudential reason. The reason is to support the transition, because with the transition, you decrease systemic risk in the future. So you do that for financial stability reason in the future, and say, I have an interest as a financial supervisor to see the transition happening, because that's going to make my job much more easier in the future in terms of financial stability. And if I can support that with some measure, if I can support the transition, I'm actually working to make my job easier in the future. And so it doesn't matter really whether you do that at the macro or microprudential level. It's just because it gives an incentive for the transition. And I think a good narrative or a good reason to add an extra layer of capital, as you suggest, is exactly to support the transition. And while you support the transition, as a financial supervisor, is mainly because that's gonna enhance financial stability in the future. So it's a bit about why the measures are similar, and I think they also have a similar goal. So whatever, if you do it at the micro or at the macro level, it has the same intended goal for financial stability.
Yeah. Okay, Pierre, thank you. That's very clear. I think we're just at the end of our time now, and I'm just quickly checking. I think unfortunately, Jochen cannot turn on his mic, so we can save that for another time. Perhaps I will just give you both maybe a quick 30 seconds to give any final closing comments. So Laura first.
No, just to say thank you so much for the opportunity to give my 5 cents to this really important work. I think it's a good moment to have these conversations, and also be mindful on the potential unintended consequences, how to anticipate and how to handle them, and weave that into any future discussion. So thank you so much, and congratulations again, Pierre, on the paper.
Okay, thank you, Laura. And I think you've also done quite a bit of work with your own paper on steps for regulators in Asia as well, and so perhaps we can save that for a future discussion and a future webinar.
Definitely.
Okay, thank you. And Pierre, any final comments from yourself?
No, thanks a lot. Thanks a lot for the question. I think it's not black and white always. So in a paper you try to present the good thing, but as you say, you must also be aware of the fineness of implementing such thing. I just wanted to tell. I mean, if anybody wants to continue the discussion offline, please feel free to reach out to me. I'm happy to do that by email. And I hope that it was stimulating for you.
Brilliant. Yes, definitely, Pierre. And of course, please do feel free to get in touch with Pierre, or if you want to channel it through myself, I'll also pass it on. It's always good to keep engaged on these and develop the thinking further. So thank you very much, everyone. Thank you especially to Pierre for presenting today and being up early your time, and to also Laura to join us in this discussion. And thank you all for being here and sharing your thoughts and questions. And we look forward to holding future such webinars on this topic. Thank you very much. Goodbye and take care.